Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's May 28, 2022. Let's get started with the year-to-date performances. S&P down 12.57%. NASDAQ down 22.31%, Russell down 15.65%, and Dow Jones down 8.6%. Everything is still bearish trend on DDAP, and our system is signaling a 75.9% chance of risk off. We are still in stagflation, still in heavy stagflation, 41.2%. We did drop off a little bit from last week, but I mean, it's expected, especially when you get a market rally like we had this past week. Let's take a look at the calendar. Monday, market is closed. Don't forget. Tuesday, we got Case-Shiller Home Price Index, FHFA House Price Index, Chicago PMI, Consumer Confidence. Wednesday, we've got PMI Manufacturing Final, ISM Manufacturing Index, Construction Spending, and JOLTS, and the Beige Book. Thursday, we've got OPEC meeting, Motor Vehicle Sales, ADP Employment Report, Jobless Claims, Productivity and Costs, Factory Orders, EIA Natural Gas Report, EIA Petroleum Status Report, and Fed Balance Sheet. So Thursday is a pretty big day in terms of market moving events. Friday, we've got employment situation and ISM Services Index. So let's look at how ES did this past week. We had what looks like the start of a bear market rally. We're not even at upper vamp yet, but this could have legs. Seems like a lot of people got short at the bottom, which this is why we tell you not to do that. You always want to short tops, and honestly, this is probably not a top here. This could have legs. We could even see up to Momo. And yeah, I mean, just stay safe out there. Don't rush into positions. That's like stagflation. This is the regime where you get hurt both sides. So what we're doing, we've got our long-term macro outlook, which is down and to the right. So we just hold our position and we don't get snappy, we don't get jumpy until things change. Nothing has changed this past week. We're still in the same boat we were at a month ago. Let's look at ZN. Not much movement. We did come off the bottom, come off the lows a little bit, but we're not in deflation. The odds of us getting deflation are still pretty low because inflation doesn't look like it's topping yet. We're going to talk about that as well today. But yeah, inflation is not topping, so TMF is not really going to move. We're still in a hiking environment, which is going to hurt ZN still in the short term.
Okay, guys. So let's take a look at the VIX and ANFCI. And let's just say what is going on right now. So we have VIX coming down, just hovering above 2571 as of Friday's close. ANFCI is the last reported number is 0.01. So we are in positive territory on the ANFCI, which is it means that over time the financial conditions are much tighter than normal, which is to be expected with the Federal Reserve tightening. And what we do know about the relationship between ANFCI and VIX is that they move in tandem, meaning tighter financial conditions lead to a higher VIX. So VIX is chopping sideways, hence the kind of stagnant ANFCI. Sorry, the stagnant ANFCI. So what we're looking for here, I'm sorry. Sorry about that. So we have the ANFCI coming back towards zero, and VIX is still just hovering, chopping sideways, meaning that ANFCI can chop up here for a while. It doesn't necessarily mean because VIX is going sideways, ANFCI is going to collapse, and in turn, financial conditions will remain tight.
So that's
Now,
essentially lower liquidity, right?
exactly. So tighter financial conditions means lower liquidity, and another way to wrap all this together is if we were to throw the Fed balance sheet on here, and I guess we'll do that right now. Um, sorry. All right. Let's see. Nope. What's a balance sheet? I always forget these trading view tickers. Is it yeah, here it is. So something about the balance sheet is as it rises, it's a market liquidity enhancer and a volatility suppressor. So as you can see down here, once the balance sheet peaked in late 2017, going into 2018 and started declining, out of nowhere we get these crazy VIX environments, and the financial conditions pop up too. And we have a series of tweets that go over this. We've spoken about this kind of I believe almost consistently over the past couple of months here with what's going to happen with a falling Fed balance sheet in regards to market liquidity and volatility. So obviously they're good, they're skewed or poised to go higher here, given that the balance sheet is inversely correlated to volatility, and volatility is positively correlated to financial conditions. So just think of it like this: the balance sheet's down, VIX is up. Because VIX is up, financial conditions and liquidity will stay tight. Will dry up and stay tighter.
So essentially, if you have any long vol positions, the odds are in your favor in these
Right, and it would.
conditions.
Yep, and that's why we continue to hold our. We own VIXM around the 30 mark. It's at 34. We are still going to hold it because, even if VIX does trade down to 20, which again possible, yeah, just like you said, could ES grind all the way up to 4400s? Yes, possible. I mean that's Momo. You know, we like to say that Vamps are the most probable, but if Vamps don't hold, Momo's the next most probable. So it's just levels and layers to the cake. Like if Vamps don't hold, then it's Momo. If Momo doesn't hold, then maybe the trend's changing, right? Going back to March of 2020 or early or late March of 2022, Momo held for a couple days. It broke higher. A lot of people got excited, and sure enough, we went right back under and fell and basically went to shit. So this is going to be an important level to watch. The 4405s and obviously upper vamp at 4211s or pretty much 4212s at this point is something we are watching very closely. Well, let's get into the CRB index and inflation
Yeah.
and
So
crude
this
oil.
this is why we are not at peak inflation. Inflation has definitely not topped. I don't know why people are saying that all of a sudden, but like look at commodities. Like
Right.
commodities are making new highs. This doesn't happen with a peaking inflation.
I know. And that's something that everyone has to pay attention to because everyone's really focused on this. And we'll go over this quickly. The world interest rate the federal funds rate interest rate probability, right? How many rate hikes are we going to get into the end of the year? We've reported on this over the last 3 podcasts. And it's been rather constant now for at least a week and a half, 2 weeks here at 7.2 7 and a quarter. And it was slightly under this going into the Fed minutes this week. Came down a bit now. It's still pretty much the same. I don't, we don't need to get into the minutia here. It's 7 and a quarter. This needs to drastically change because it's giving us an implied rate by the end of the year of 1.82. Excuse me. I'm sorry, 2.64. A 1.82 percentage point change, leading us to 2.64 by the end of the year. A lot of people are saying that we got two hikes, and they're done. That's the consensus, is that we're hiking 4 times and we're pausing. Well, the market's still pricing in more, and rightfully so. Let's go back to what we were talking about here. We have the CRB index creeping higher here, printing a new 52-week high into Friday's close. Something to watch with the CRB index is crude oil. It's a big component of the commodities index. And that too closed I want to say it's very hard to see here. Did it close above the yeah, just about.
It
Yeah.
might have,
Just
yeah.
yeah,
So
just about
we're actually
above.
really close to peaking out on crude oil, and like the commodities index already peaked out without crude oil peaking out, and when crude oil peaks out, the commodities index is going to go nuts.
Right. And that's something that you're seeing at least as of Friday, right? It does look like we have a new closing high here on crude going into Friday's close. We can just check right now. I could tell you to be exact here. We have a 115.07, and here we have a new closing high here as of Friday, Friday's close. And the next high, closing high, because we don't have the candlesticks on for crude, is 123.70. So obviously, if crude gets to 123.70, the CRB index will be much higher. It's quite surprising that the CRB index is already printing new 52-week highs, and crude oil is not. So that's something to pay attention. Meaning crude oil has the potential now, as long as CRB stays at new 52-week highs or above the prior 52-week highs, I should say, crude can grind higher towards its 52-week highs.
Yeah. And
Now,
what this means in terms of our regime model is stagflation is not over. Deflation is not coming yet. So
right.
that's why we say, the ZN, people trying to catch the bottom on ZN, buying TMF, you're going to get smoked. Inflation is still here, and bonds aren't going to rally until we get deflation. And deflation is on the opposite end of the spectrum. Inflation has to fully reverse, and it's
Yeah.
still peaking. Like, it hasn't even slowed down. It could still accelerate,
Right.
if the
Yeah.
Fed really
Yeah.
messes up,
I
it
mean,
could definitely accelerate.
let's take a look at the inflation year over year. Right. So we have the peak at 8.5, the last reading in at 8.3. This next reading, commodities are now higher. Crude oil is now higher after this reading. We're going to come to the point where we're going to be guessing that new all-time CPI is on deck. Not all-time, I'm sorry. New cycle CPI reading is on deck at some point here. If commodities keep this up and crude oil keeps grinding higher into the next CPI reading, we're going to start thinking that we have a new cycle high on deck.
Yeah.
Because if you look at it, and I think this is much more comparable to crude. If you look at crude oil, right? You had this. Remember, CPI is delayed, so we had crude peaking here, CPI peaking here, just kind of like how you have. I should say that the CPI is always the reading of the last month, right? So as you see here, it peaks, right? CPI peaks, but it takes a few months for the downturn to be registered in CPI before the upturn. The upturn's not immediately registered. This acceleration is really like from 30 days before. Does that make sense?
Yeah, exactly.
Yeah. So this peak is likely this action over here. CPI came out here on May 2nd, right? Registering the whole month of April, which if you look
Yeah.
at the month of
So that was
April,
just the
look,
chop, because
let's draw.
commodities did slow down. They chopped around, but it was just gearing up for the next leg higher, and that's what we're going to be seeing pretty soon here.
Right. So let's draw this in quickly. Let's draw the month of April in, just to give it an idea of what this last CPI reading encompassed. This is what the last CPI reading encompassed. This downturn you see in CPI was this. We are now higher than the highs of that period, right?
Yeah.
So almost you're going to want to say that we're going to be at this point we're going to be above 8.3. Question is, do we get a move above 8.5 in the next reading? This is what I'm saying. If commodities keep this up, we're going to start leaning more and more onto the side of having a new cycle high print in CPI in the next reading, depending on what commodities do over the next what do we got? We got a week here, right? We got next week, I think, right?
Yeah, I think it's next week.
Is it next week? No, it's the week after. It's the week after.
Yeah. Okay.
It's the week after. So it's the week after next week.
Got 2
That's
weeks.
where we're gonna.
And
yeah, we got. Go ahead.
I think in those 2 weeks, oil could easily break out
Right.
to new highs.
Right. I know, and that's something that no one is prepared for. Everyone thinks this is the consensus. I mean, goes back to our video 2 weeks ago, the watch and learn with the David Hunter, right? Dollar peak, rates peak, commodities peak, right? I believe it was commodities. Certain commodities he said could have some strength, like copper.
Yeah.
Long story
The
short,
growth commodities.
Yeah, the growth commodities, right? He was saying that the top in crude is in. It's going to like 80 a barrel, something like that, right? You will not see a peak, a definitive peak in rates or commodities broadly until crude peaks. And this goes back to us, our analogy in the prior video that everything runs off of crude. Like to transport all your goods, you need crude. If it's diesel that's refined or whatever, right? You need oil to transport everything. So if oil is continually going higher, the cost of everything else will continue to go higher.
Yeah.
So that's something to watch, right?
Yeah, and let's kind of tie it into FOMO, because
Right.
with this market rally that's going on right now, it's easy to get FOMO. You know, it's understandable. Like what did the market even rally off the lows?
I'll tell you right now. Here, let's see. The lows on ES to the close was 9.15%.
Yeah, and that's that's quite the move. It's easy to get FOMO. You know, you make 10% just from holding some shares in like a week. 10%. That's pretty good. But nothing has changed. You know, the only thing that has changed is the price. So you're getting FOMO because the price is higher. Why are you getting FOMO now? Why didn't you buy when it was the low of 380 then? You know what I mean? So
right, and I think another important thing we have to emphasize: 9.15% on the S&P 500 in 5 trading days or 7 days. Five of them being trading days. In 5 trading days, we went up 9.15%. What is that like? Is that like a signal that the risk is now back on? Because it's not to me.
No, like literally nothing has changed. There's no reason to get FOMO. We have our theory on what's happening in the market, and you know our theory is pretty damn good, and it's accurate like almost every time with our model. And nothing has changed. Honestly, I think it's gotten worse. This is a pure technical rally of people getting squeezed out of their shorts. That's all it is.
That's my point, right? So that's my point in saying just the market rallied 9.15% in 5 trading days. We'll use the trading days. It can certainly go down another 9% in 5 or 6 trading days, right?
Yeah.
It could go up another 5% or 9% in 5 trading days. I mean, the last rally we had to endure went from 41.55 all the way up to a high of 46.31. In 10 trading days, we moved 12%.
Yeah, and we could easily see that again. We can rally up to Momo, but
and
that doesn't mean anything changed.
No, it doesn't. But just a perspective, Momo currently is just about 15.6%, 15.7% away.
Yeah. And
So that means you have another 6% or so from Friday's close of possible squeezing that could happen. Do we think it's going to get that high? No, I mean we're holding our full portfolio for a reason. Obviously it could, but anything could change along the way. It could go up to 42.50s, 42.12s, upper vamp and just do a reversal. But the whole point is we don't know when the reversal is going to happen because the market's been beaten down so much. Um, and a relief rally is to be expected. And this is not a system changing event. You can't look at the entire system, or the system is what we call our model, and you can't just take a specific bullish underlying, if it's the S&P, if it's one thing, and say, oh, this is really bullish, or there's a lot of like powerful upside here. That means everything's fixed. It doesn't work like that. Because if I were to show you VIX, right? Look at VIX. VIX hasn't had a bearish trend since November of 2021.
yeah.
So,
Eh,
and even in April of 2020, like that March rally that we were speaking of, where the market went up about 12%, VIX couldn't even put in a bearish trend there, and it actually chopped under for a while. So, a lot of things have to happen on the inside here to really shift the system into thinking that it's risk on. We've been saying for I think months now that we are here. We are here. This is a likely next. Could we stay in here long enough that we skip this phase? I mean, yeah, it is possible. Do I think that's the probable outcome? No, I think we are going to pivot to deflation at some point. But we have to take what the model gives us. It says we're in stagflation, so we have to stay according to plan. Stagflation means GDP will slow while CPI rises, which goes back to our whole inflation being peaked. Inflation hasn't peaked for us until the where is it here? Until until the system has a system strength that's confident in the next regime. What do I mean by that? What I mean by that is the background is orange. Real simple. It says stagflation. Inflation has peaked when we have a deflation pivot with greater than a 50% system strength. Most of the time, that's rather normal. I mean, unless you you look back at time, there's a few occurrences where that doesn't happen. So once the system pivots with a stronger than a 50% system strength, we are in deflation. Meaning, if we are in deflation, GDP is falling, but so is CPI, aka inflation has now peaked. Will we be late? Yes. Will we miss the move? Probably not. And this goes back to us talking about FOMO. And this is something I'd like to bring into just let's talk about the commodities first, right? If you look at the commodities where they are today, they went bullish DDAP trend in August of 2020. In August of 2020, we were expansion. Okay? Then we moved to inflation shortly thereafter. In let's see, in I think it was November of 2020. So from August, let's just say you use November here to get in, right? For the real inflation move, the CPI, right? Rising.
mm-hmm.
You had this whole entire time, all these dips in bullish trend with the regime in your sales. Always put the regime in your sales. You can't change the regimes or the system outputs, but you can change your portfolio outputs. So always make sure your portfolio is lined up so the wind of the regime is in your sales, because long commodities this entire time was a great trade, right? Or a great investment, I should say, multi-year investment here. And we're still bullish trend. But let's just take a peek at when things go really south. Like let's look at here, right? Here they go bearish trend. Let's go all the way back to 2018. The end of the early, or I should say Q4 of 2018, it goes bearish trend and basically falls apart. And then we bounce in 2019 we go bullish trend. If all you had was DDAP, you would say this chart is this chart's confusing, it's choppy, it's not definitive, right? But you would know that this pop here in 2019, the system was printing deflation. So you know that this was a whole lot of horseshit. This was nothing, right? You have the system aligned with you. You're not long commodities. You know that this is not real. And sure enough, you get the breakdown. Same thing happens again here in 2019. Commodities go bullish trend, right? The end of 2019, going right before COVID.
Mm-hmm.
System stay deflation. So you know, again, commodities are not the move. And what ends up happening? They shit the bed. And they really shit the bed into COVID because we got a real multi-sigma deflationary event. And after that, they bounce. As soon as the system aligns, look what happens. You get the move.
Yeah.
Where's the FOMO, right? You know where the FOMO was? The FOMO was here. The FOMO was here, right? The FOMO was in here, in here, in here.
Yeah, exactly.
Like
people getting in on every little pop because they think it's reversing,
right,
trying to catch the bottom.
Right. And let me ask you something. Let's just say we bought in November. We came to the commodities game multiple months after they went bullish trend. We waited for the most optimal time to own them. We were buying the CRB index at one. We'll use DBC, right? Because it's a little bit more liquid here. So November. Here, I think November. Yeah, right here, right? So we're buying here at like one. This is a bit different because this versus the CRB index has more time and space to plot data than the DBC. So it's just the trends are a little aligned. We always go to the upper when we look at momentum and trend tracking stuff. We always want to look at the most robust asset, and that's the Reuters CRB index. It has the most amount of data, where the DBC is more of an ETF. But we'll just bring this for the example of owning it here, right? Of owning it at 14. Let's get back to the point. We own DBC at 14. Call it. Now we're ripping. We're all the way up at 29. Cool. But let's just say we go before we went that bullish trend and bought it at 14, and we just look at this time frame, right? We're in here after COVID. It would have been nice to own it here, right? At 11 or 10, or even here at 12, right? This whole way up. Maybe even the lows down here. Maybe even even here if you bought it at 12 during the pandemic crash, you still made out decent as of today's date. We bought it 2 points higher. We sacrificed this move here, this nonsense, for conviction because we knew what was going on. And this is what's important, because what's to say when you're buying it that this is the low, this is the low, this is the low, this is the low? Because just remember, drawdown wise, if you would have bought the dip before the first pop, it drew down another 27.2%.
Yeah, and would you have even been able to hold through that drawdown? Most people
right.
can't.
I know, and
especially if you're going in with conviction and you're putting a lot of capital down, large percentage of your portfolio. Can you really muster a 27% drawdown? Not many people can.
Right. And if you bought, let's just say November, the end of November, which you would have bought before, just given the CRB, obviously the CRB was bullish this entire time, you would have been probably loading into the pivot here into early November, right? Or just after, around Momo, November 5th, which on DBC was here, right? But let's just take it for the sake of that. You just looked at DBC. Let's take the measuring tool. Let's say you own it at 14. Would you draw yourself down realistically? We'll go 14. We'll take the peak 14.10 to make this easy.
Yeah, the worst entry possible.
And you drew yourself down 1.95%.
Yeah.
And this goes back to us saying, okay, if we can reduce drawdowns, why not introduce leverage, right? Because you drew yourself down 1.95%. I can handle that. Most people can handle that. Can, times that by 3, right? 1.95 times 3, you're at 5.85. Most people can handle a 5.85% drawdown. So let's go. Why not 3 times leverage it?
Exactly. Why not?
right?
If you're really risk averse, why not get in the money options that have, synthetic 4 times, 5 times leverage?
Right. Right. And but like you will do well with that strategy, right? Using options and leverage if you understand the path of where the regimes are going. And this goes back to our concept last week. If you're in expansion, right? Or let's just say you're early inflation for the commodities trade, right? You're just flipped to inflation. Well, inflation is going to last a while. It's not going to be a 1 month thing, and usually isn't, right? And then stagflation is usually shorter. So you know that you're getting an early inflation. You could ride this out, and then you could probably ride it out until at least there's some weakness in stagflation. Obviously, stagflation has usually been preceded by deflation at a very quick rate, but we've had one of the stickiest CPI components for a very long time, which means that while GDP is slowing, CPI is it's basically forcing us into a rather very sticky stagflation. Usually it's not that long, right? But because CPI is so sticky, or the inflation aspect of growth and inflation is so sticky, we're stuck in this sticky stagflationary period. But we know that inflation tends to run. So if you're in an early allocate, you have early allocations, right? You're very well positioned to the waves and buy and trimming the tops and buying the dips. And this goes back to our second strategy, or our second component of our DDAP tool that you can use to create your own strategy, right? Dips are buyable in risk-on regimes. That we've made that very clear. What you could also do is you can also sell premium on the rips in risk-on regimes, a couple percent away from upper vamp. So if you look at the top left corner here, we have a red marker and a green marker. The red marker is percentage away from upper vamp, and the green marker is percentage away from lower vamp. So as you can see right here, we were about half a percent or 50 basis points away from upper vamp. Every time you see that, you could put something together where you sell 1% out of the money options. Now, if you get called away, odds are it's going to run upper vamp and pull back at some point anyway. You could repurchase, right? But this is just a strategy you can do. You can think of on your own when you have DDAP. You can put a lot of puzzle pieces together and make your own portfolio, right? And in risk-off regimes, what you can do is you can sell credit spreads if you really want on near upper vamp. The problem with this is risk-off regimes are very well known for aggressive bear market rallies, and you have to be able to make sure that the credit spreads you're selling accommodate for a potential higher than expected move, given that a bear market rally tends to rally a lot farther and a lot stronger than most people think.
You also got to watch out with options plays in risk-off regimes because the VIX is usually pretty blown out. So you got to watch out.
Point.
You got to watch out for your options plays because due to the volatility priced into the options, it may be a lot harder and a lot less realistic to make money selling premium or any other options plays.
That's a good point, because if we go back to VIX here, right? All of you could just look at, we'll go back to a different time period, like here, right? In 2018, right before we had this big VIX blowout, this is when the what I'm trying to do is I'm trying to tie in the Federal Reserve balance sheet. Knowing the direction of that, you can almost guess what's going to happen to VIX. By guessing what's going to happen to VIX, you can allocate accordingly in the portfolio. Like, we know VIX is going to stay elevated as the Federal Reserve cuts the balance sheet. So, like you said, Artie, options are not ideal because what ends up happening is the vol stays elevated, meaning purchasing options become more and more expensive. And all it takes is vol to get crushed and you to be really smoked.
Yeah. So we prefer options during risk on periods. Our strategy is selling covered calls on our position. That's
right.
We use leveraged ETFs to avoid any time decay or any options bullshit. And we sell covered calls at upper vamps on our positions. So
Yeah.
that's
Or
with
or
our
or
yeah. Go
or
ahead.
or you can just sell a portion of the position, right? It's either whatever you decide to do.
Yeah, that's true.
Right. So it just
Covered calls
we
are
want to
nice
let
because
yeah.
you get like a nice consistent stream of income. You can sell, covered calls every 2 weeks, or you can just wait for upper vamp touches. That's what we like to do, wait for upper vamp touches. But if you want consistency, you can do every 2 weeks, and you adjust how far out of the money you sell depending on where we are relative to the vamps. So there's plenty of ways you can do it to really work with your risk tolerance. You can even
Yeah,
do like
I
non-leveraged
made
ETFs if you can't take risk.
yeah, this is a good point. I made a an absorbent amount of money here on Tesla back in 2014, just selling covered calls, right? Knowing that upper vamp, I'm going to sell some credit spreads, and Tesla was notorious for ripping and getting killed so quickly. Like here, for example, I think which one I had them right before earnings. This one of these earnings, I killed it, but because IV was so ridiculously high because it was Tesla was moving. You're talking about if we go to a weekly candle, right, back in it's 2014, 2015, right? This area right here. We're talking July. In 49 days, you're moving 30% and then back up again. And then back down, back up. Like this thing was just chopping everywhere. And there was a lot of money to be made in the options of just collecting premium on both sides. Went up, down. You were you were selling calls, selling puts. Then I was selling puts. Or no, I'm excusing the other way, completely the other way around, where I was selling calls, selling puts, and then I was selling calls and selling puts too. I guess I wasn't really following DApp too well back then, but I was just trying to rake in as much premium as I could because I knew that the company was going to struggle. And obviously truth be told, I'm sorry. It was in 2014, 2016, not 2018. My bad. I'm the chart looks the same for both periods, but as you can see, the company plateaus for a while.
Yeah.
We haven't had that. We haven't had that. Now we're getting this plateau again. So what makes me think is it wasn't so much Tesla, right? I want to make this clear. I don't want this to be a video about Tesla. It wasn't so much Tesla. It was that during the 2016 or 2015 area, right? The market itself going into here did absolutely nothing,
Yeah. And that's
right?
that's why if you're washing your position, that means like buying at lower vamp, selling at upper vamp, and then reloading again at lower vamp, doing that, or selling premium, selling covered calls, things like that. You're constantly generating money, even in sideways markets.
Right. And that's what's important because we will get a regime where the market goes a back-to-back shitty risk regimes where market's going to go sideways. It's going to happen. The question is, how do you capitalize on that? Well, staying net short the entire time is not ideal because what ends up happening if you look at SPXU, this is the most outside of shorting futures, this is the most simple or basic way to go short because you're essentially long something, right? So you're not borrowing. I mean, the borrowing costs are baked into the product itself, but you're not going net naked short in your brokerage account. You're basically just long and inverse,
Yeah,
right? You're
and
long
and
and
some
you're
people,
invertedly
they
long.
don't have permissions to go short
Right,
in their
right,
brokerage account and stuff. So
right. So what ends up happening when the market goes sideways, let's go back to 2015, 2015, 2016 area. Even though the market goes sideways, this can degrade very fast to the downside because of the derivative delay or derivative decay of the entire fund's holdings. So it doesn't like if you have a very very long um, flat regime, pretty much a stagflation that what you're seeing kind of like right now, right? Um, our system picked up stagflation back in was it
I
April
think it was
or
April
May of
9th.
it was April 9th of 2021,
Yeah.
right? And if we just were to take a line here and go to SPXU, and let's go to April 9th, 2021. Take a line, April 9th here. We have not even gotten above that level once yet on this whole rally. But if we look at April 9th here on our ES chart, April 9th, 2021, we were well under it just a week ago. What I'm trying to explain to you is just because the markets are in risk off and we're going down doesn't mean you could just blindly hold these risk off a naked short or a net short portfolio. You have to understand that the longer you hold that net short portfolio, the market does nothing to increase risk you have that you have decay of the short positions themselves.
Yeah.
Okay.
So let's go back to FOMO. I want to end it off with a little talk about FOMO because I really don't
Yeah.
want you guys getting FOMO and making stupid trades, Like stay cash. If you're getting FOMO now, why are you getting FOMO now? Why didn't you get FOMO at 380, look at the price, and if you were to have bought at 380, what was your reasoning to buy at 380? I'm talking on the SPY right now. If you want to open the SPY chart. But like if you were to buy the dip at 380, why didn't you try buying the dip at 410 a month ago, And like what is your reasoning behind it? And how can you go with conviction if you don't have a reasoning behind it? If you
Right.
bought the dip, oh, I could have made 9% buying the dip at 380 or whatever. But how much money would you have put in? 9% on what? You're going to put in like 1% of your portfolio in there? Because it's basically gambling and you have zero reason
Do
to
you
do it.
know what a good way to tie this down is? Just pull up ZN.
Yeah. Yeah. Like
Right.
imagine how many people bought the dip on ZN over the last year. The dip keeps on dipping, man.
And
Like you
eventually
gotta
there'll be a
have
dip buyer that gets it right. But how many dip buyers themselves or others got burned in the process? It just
exactly.
doesn't make
And
sense.
and if you have no conviction behind it, you just have your little rinky dink like line charts and shit trying to predict
Yeah.
macroeconomics, you're not gonna put money into your trade.
Yeah. And if you
You're
do, you're out of your fucking mind,
yeah.
but that's okay.
You're gonna be right and you're gonna make your 10% on like your 5% portfolio allocation. Congratulations. Good for you. You got it right. But like you're not gonna get paid for it. Wait until there really is a reason. And there will be a reason. And that's when you'll have conviction. You can put a lot of money into your trade, and you really only need, 3, 4 of those per year, and you just ride the wave, and you rake in 100%.
Yeah,
Like
yeah. I
the
think that's a
TMF
great
play. When we get TMF 3 times leveraged, we're gonna buy the dip on TMF when the time is right, when everything aligns, which it will happen. Everything will align. There's always those perfect scenarios. They always come around. You have conviction to go balls deep into TMF and make 100% return in 6 months. Like that's a realistic number with TMF. 100% return on like an 80% portfolio allocation.
right.
That's where the real money is made. You do that 3 times a year, 4 times a year, you're pushing 200% gainers every year. And it's
Yeah,
consistent.
and I think that what I want to wrap what you're saying into is that it's very important that you understand what you're doing, right? So, like, what Artie's basically saying is you're gonna take what we give you, the risk management protocols, and it allows you to compound heavy, right? Because you can go in heavy, gain heavy, sell heavy, then compound even more into the next play. And this ties back into what I was talking about earlier with Tesla. I want to kind of tie this all together. The reason I had the conviction, I was focused more on the company than I was on DDAP. Meaning I wasn't too concerned about what DDAP was saying at the time. I was more concerned about what the company, what was going on with the company. So I knew the fundamental stretch of where the company was going, or what was going on with the inside. I knew they had a cash problem. I knew all this stuff that was going on, right? And it made it very easy to basically collect a lot of, be very aggressive, do things that if you just looked at the chart, as I showed you earlier, you would be like, oh, why would you do that? I mean, it's bullish trend, right? Like I was selling calls into bullish trends. I was selling puts into bearish trends. Like, it doesn't make any sense. Well, the reason I was doing that was because I knew that the company was short-term extremely oversold, or short-term it was extremely overbought, and it was going to get gonged on an earnings release or something in the coming, something was going to screw it up. So I would sell calls, and I was able, with that conviction, to compound lots of money. Pretty much, I was taking all the premium I made in, rolling it into the next play constantly, and I had like a 90. I think it was a 96% win rate or something like that. And the few times that I lost, they weren't complete 100% losers. Like the option just wasn't going my way, so I rolled it out. And by me rolling it out, I eventually made my money back. That doesn't work anymore. Obviously, that stock has changed. But what I'm trying to say is I had the conviction to make those moves that some would think are extremely irresponsible, right? Putting 80% of your portfolio into TMF would sound so stupid, right? If I draw down my my personal account 20%, 30%, I don't care. Don't need it to live, right? I'm not living off of it. I know that over time that account will go higher. Same thing with the public account, right? Look at the public account. The reason why we're taking the stance that we are in the public account, we're being so so precise, is because even if we have a 20% drawdown, that's not a big deal. When the TMF play comes around, we'll compound that. When the risk on regime comes back around after the TMF play in equities, we'll compound there too. The whole point is, just because you have a drawdown, it's not the end of the world. And also, just because you don't catch the bottom, it's not the end of the world. These things don't. A 20% draw. This is where like all these big macro guys are chirping on Twitter about this bullshit. Like, oh, only 5% drawdowns. Like, yeah, okay. If you manage a pension plan or something, you're a fund that manages pension money. You can't have 20% drawdowns. It's quite obvious. You have people drawing on that money constantly. It's just logical. But if you have a time horizon of more than 15 years or 10 years, I should say 15 years to be conservative, you can play the game. Not zero yourself out, right? Maybe you don't go 80% in. Maybe you only go 40% in, right? But you could still play the game. There's not, you don't have to have a Ken Fisher or a not Berkshire, the Bridgewater Capital account where you have a fraction of every stock, which the only reason that Bridgewater does that is because they have so much money that they need to diversify beyond belief. You don't have $120 billion, right? So you're acting as if like you're going to move the stock with your account. And that's not me telling you to go balls deep in anything. That's me telling you to understand what you're doing and understand it to the point where you have the conviction to say yourself, because at the end of the day, we do this as more of like as an educational stunt for you guys. We're not investment advisors, we're not portfolio advisors, we're not hedge fund managers. We can't tell you what to do with your money, and we can't be responsible for the gains or the losses that you ensue, and that's disclosed at the beginning of every podcast or all the material on our website. We are not responsible for your gains or your losses. In turn, the only person that's responsible is yourself. So if you got an investment advisor that only wants to put you into these small categories or these light investment areas, wants you in a piece of discretionaries, a piece of energy, a piece of utilities, he's investing in a way that he doesn't get in trouble. not in your best interest. The investment advisor's objective is that he does not get sued, or he does not get charged with negligence or whatnot for the way he manages your assets. Just remember that. If you guys are just listening and you're bringing these ideas to an investment advisor, they're going to say, "Oh, you can't put 80% of your products into one thing." And some of them might say, "Oh, have you ever heard of this leverage ETF that continues to go down?" One of them would be probably what's it? UCO? Is it UCO? No, it's USO. No, SCO. Sorry. You look at this. When they hear leverage, everyone thinks of this. This is a leveraged short ETF, meaning an inverse ETF that is leveraged. It will forever get decayed. This is not where we hold big. These are not our big moves. The TMF, remember, everything that we are telling you that we are going in size is in the right regime with the regime in its sales, and it's not inverse. You're not playing 80% of your account into an inverse ETF, so God forbid the index goes sideways, you're just getting destroyed, right? Can that happen too with a leveraged long ETF? Yes. Long story short, if on the upside it goes sideways for so long and doesn't move, you will get decay there too. But the whole point is, if you got the regime in your sales, you're less likely to run into a scenario that the underlying product that you're leveraged in via the leverage ETF moves sideways. Let's take DBC for example. See, look at it. We are ever since November, it is CPI rising. Very, very rarely do you get caught in some sideways action, and it's very short-lived for a few months, and it goes higher afterwards.
Yeah, literally no drawdown since entering the position.
Right. So what I'm trying to say to you is you need to understand, I'm talking about the listeners, to you guys listening, you guys need to understand what you are invested in. Not so much the products to their prospectus, every period in their prospectus, but more of why you're buying those products. Why do you have FOMO? Why are you scared of missing the bottom? Because I promise you, even in COVID, look, you missed the bottom. Okay, did I really miss the bottom though?
Yeah, you got to get the meat of the move.
Right.
You essentially sacrifice not getting the perfect bottom for conviction.
And I think that's the best sacrifice you could do.
That is the best sacrifice you can do, because that when you have conviction, you can go in with size and make real money when you're right. If you're buying the dip, no conviction, you're just sprinkling a little cash in there, oh, maybe I'll get lucky. You can be right and not get paid for it. So what's the point of even doing it?
Right. And I think a great way to end this off is because everyone's all hyped up about the TMF TLT bond trade. Let's look at TLT quickly. TLT, back in the late 2018, right? We got the deflation pivot at the end of 2018. TLT's lows were about 111. If you would have bought the lows, let's just say you nailed the lows. Okay. You nailed the lows on TLT and you held to we'll call it 170 to be fair. Just about 170 here. 170 to whatever for the sake. You made 52%. Okay? Now let me show you TMF. Okay? Let's just say we used bullish, so we would check ZN. This is the process, right? So ZN goes bullish December 2018. So we're not buying no TMF. We're not going into TMF until there's bullish ZN, which we see that here. We'll buy the dip, right? And let's just say we sell. This here is a hiccup because ZN never went bearish trend.
Yeah, so you'd be holding. You wouldn't get stopped out.
You would be holding this. This is just like head fake. And you sell here at neutral trend. You don't even get the top and the bottom. You make 124%
in the span of like a year.
587 days, right? Just remember,
year and a half.
Let's go back to TLT. What was TLT's gain from the lows all the way up to 170? 52%. I did not have to pick the lows. I did not have to guess the top. I just followed the system and I made double, almost getting close to triple Well, you made holding TLT.
And the beauty of that, the little cherry on top, that's not including selling covered calls, doing wash trades between upper and lower vamps to bring in cash throughout that whole year and a half period. That's
Yeah,
not
like
including any of that.
what he means by wash trades is our little inside term. It's our market radar term where you load the lows. You go extra leverage on the lows. Like I'm saying, like if you want to sit at a 40% allocation, you go to like a 60 or 70% allocation on the lows. And the first popped up revamp, you unload that extra 30 to 40%. And you trade that extra 30 to 40% while holding a core 40% or whatever you take your optimal allocation and you want to hold that consistently. I should say your optimal allocation for the entire trade, let's just say it's 40%. But you're okay with going stronger size in the shorter term, then you add whatever you're comfortable with on top of that and you trade that on top of that 40%. So you basically are compounding returns in the meantime. That's our term washing. If you ever hear us say that, that's what we're referring to. But yeah, I think that covers it. That encompasses everything, and I just want to make sure that everyone listening and following what we're doing understands where we're coming from with this. Get this FOMO out of your head. It's useless. It doesn't really work. It only hurts you.
Yeah, I think that's a good way to end it off. Thanks for
Yeah.
listening.
Thank you so much. See you guys next week.